Hey everyone, Douglas here, Kenner Market Analysis, and welcome to the weekly macro update for Tuesday, September 17th, 2018. It's 5:46 a.m. Eastern Standard Time, and I apologize about the delay in getting this posted, and I appreciate your patience in that. I haven't been feeling the absolute best, but feeling better, and yeah, we'll just go ahead and dive on into things today. I've also got the webcam off as well, since I don't look too well either. Early in the morning. Anyway, with that being said, let's dive into things and get going with the assessment of everything. We'll go through kind of the normal data lineup, and then I had I was talking about oil, big news there with what's happening in Saudi Arabia, and then we had a kind of a question comment regarding the rate cut decision or just the rate decision tomorrow. And I'll talk positioning as well. So yeah, let's dive into things. Got the macro triangle, and I still think we set up pretty darn nicely. As we'll see, I think the fiscal flows still remain in a bullish setup, all things considered. And I do think this might change as September rolls through. And I'll kind of explain what we want to be looking for there. The private debt situation or the banking flow situation remains quite strong. And again, we'll look at that data. So I'm going to be bullish on that. The interest rates remain low, so that is supportive of at least money wanting to flow into the equity space, and so that that remains bullish. And then sentiment, momentum, volatility, all looking pretty darn bullish, all things considered. I debated between bearish, neutral, bearish for the rest of the world. I think the data for the rest of the world might be turning. We'll look at that real quick. So I decided to go away from bearish, but you could easily say bearish with the overall global risks right now that are occurring because of the tensions and the recent attack in Saudi Arabia. But even then, with that occurring over the weekend, that pushed down the S&P all of 0.25% from where we were at closing on Friday. So. It was kind of a difficulty going between kind of the news and rest of the world in terms of the total implication that would have on markets, primarily equities, in mind when I'm doing the macro triangle. So I still feel pretty high conviction that we remain in a pretty bullish environment, all things considered. So let's look at those fiscal flows first, and I want to kind of explain something here as we're now about halfway through September, and let me get that turned on. Here we are in terms of kind of what we want to be paying attention to. So all things considered, the continued momentum continues to push higher in terms of kind of the daily average of new money entering the economy, and as you can see, we are quite ahead of our last year average. So 2018 is in orange, 2019 is in blue. So far so good for September. And again, relative to last year, the difficulty is, or the risk here is that usually as September finishes out and early October rolls in, that's the fiscal year rollover here in the United States, and oftentimes we see the spending begin to wane, and sometimes you get kind of last minute spending cuts before new budget decisions are made and that sort of thing. But so you can certainly see that average from August to September is rolling over. And but relative to last year, though, September is pushing or at least holding steady, or again relative to the prior year. So what I wanted to do is just show you as I jump to the actual data set here. I don't know how well this will show up on your screen, but I will still kind of show this. So notice how we'll go back to July of 2018, show the average there. You're at well, I guess July was pretty low. Let's just go ahead and do August of 2018, and you had an average of 21 billion per day, and then you can even see too just some of the numbers showing up. You then had September at 15,000, so a big swing from the August bump back down to 15,000, which was actually below July. and then finally, once we get into October, you see the average start to tick back up before you get a big burst in spending come November. And again, I don't know if you can see this average at 22 billion a day. So the October average was 15 billion a day. So the point being is that in September and into October, you get a little bit of a wane in spending, and then what that does is that puts pressure on the banking system as a whole. Without that new money coming in, that's it's kind of the reserve base that then goes out and goes into more risky assets, whether that is from just bonds, kind of simple assets, or kind of less risky assets to the more riskier side. Some of that even finding its way to into equity. So that's going to be the risk going forward as the month wanes and we enter the second half here. That if we see any big slowdown in the fiscal spending flows, that would potentially put a hamper on liquidity. And that's why as I switch back to the browser here, I'll pull up the S&P. Let me go to the daily chart here. That's why I think there still is kind of a likely possibility that we get a little bit of a pop here through kind of the prior resistance into a new all-time high territory, and then we get a pullback for a minute wave 2 before we go ahead and then take off from there into kind of the Santa Claus rally, if you will, as we then enter the months into the end of the year. So that's kind of my thought. Obviously, there's a lot that can change, but it fits pretty well with the data and with kind of what we'd expect, not only from the chart pattern, but the Elliott count as well. So it's kind of how I'm seeing things from at least that fiscal flow perspective. All things considered, though, we're still at amazing levels relative to anything we'd expect, the relative levels being fiscal levels relative to anything that we would expect that would induce any sort of recession. I continue to see, especially on kind of the big macro voices and macro practitioners, the recession is right around the corner, and I still just disagree. I still think we might be having some issues here and there, but all things considered, the necessary environment and necessary ingredients for a recession just are not there right now. Let's go ahead and look at some of the banking flow data and see where we're at there. All right, starting off with total assets of foreign-related institutions. Again, this is a good kind of leading indicator to risk assets, primarily equities. And we continue to see a little bit of a consolidation here over the past couple of weeks in terms of foreign assets, but no big reversal in the upward trend. So yeah, we'll want to keep an eye on this if we do, and I do think we probably will break higher as good confirmation, or get another leg kind of rolling here higher is kind of good confirmation of a next leg up in equities, again the red line being the S&P. So good confirmation in terms of where we're at here. So this is looking strong. Looking at risk assets or other securities on the U.S. side of thing, and we saw a very big reversal, which we were expecting in terms of again those other securities being risk securities or risk assets on U.S. bank books. So yeah, good motion or good activity there. We're gonna also want to see some follow through on that, which I would definitely expect. And part of the reason that I would expect it is we've finally seen a bit of a slowdown again here in the blue line of treasuries being taken on to the books. Technically, we had more month over month, week over week, but the rate of change is slowing down, and we're seeing that again kind of go in concert with treasuries rolling over. So I've just got the inverse of the 10-year to kind of show the correlation with the bonds. So in other words, the idea would be bond prices are going to go down. And again, this just to me, that the big thing I'm looking for is bond prices to go down because one, I think we had kind of really a false move and overpricing here. And then two, as they go down, that opens up more room for more speculative and risk risk assets onto the books of banking institutions, giving us kind of the necessary buying pressure we need to see a rally, which is certainly what we are expecting at this point. So yeah, good things happening in the bank flow side of things, and no real risk here, and finally kind of confirming what our suspicion has been, especially on like the U.S. side, but the others have been showing strength. Let's look at sentiment real quick. Finally kind of back to normal levels, at least above average levels on the bullish, and below average or slightly kind of average on the bearish. So a lot of kind of sideways neutral style sentiment here. So by no means are we overly bullish or even overly bearish anymore. So the total index should add to 100. So we're at 31 on the bear index, 33 on the bull index. So that would also mean that the neutral side would also be right there at 35. So very flat across the board on the sentiment side of things, just meaning that we still have a very nice kind of run up ahead of us in bullish sentiment, kind of if and when we do break out. So there's no real worry there. The next thing I want to talk about real quick is just kind of the rest of the world, where we're at. I mean, just looking at the Euro manufacturing PMI, which would really be essentially majority German PMI, and looking at other data, they technically are based at least on using PMI as an indicator in contractionary environment or recessionary environment overall. But we're starting to see a bit of a turn there, and yeah, I guess I've said it before, and I'll say it again. I think the rest of the world is in a very precarious situation for lots of reasons. It's not good, but we've at least seen a pause so far in the data that we do have to indicate that we might get a breather here, for a moment or two. I don't think it'll last long, but I guess I'm really trying to explain why I'm not in full out bearish mode right now, and I'm just going to go ahead and say that we're in neutral bearish, meaning we're not in a good spot by any stretch of the imagination. But what we're not seeing is rate of change pushing downwards. We're actually seeing that kind of rate of change stabilize at the moment. So that's kind of where I'm at with the rest of the world at this point. And speaking about the rest of the world, the next thing I want to talk about is the next thing I wanted to talk about is the attack, the drone attack that occurred over the weekend, and its implication on oil. This sort of stuff. Obviously, it's you can't. There's no way to assess it from a data standpoint. Is there risk? Yes, but I think there's risk both ways, that maybe things settle down and all is well, and nothing all that traumatic comes of it. And on the flip side, maybe this could be an escalation of something bigger. But what it does do for me more than anything is it does kind of confirm, or at least indicate, that we might be possibly carving out a longer term sideways pattern here. We had been certainly thinking that oil prices might start pushing higher. That obviously occurred. And I believe this is based on what I heard, or the headline I saw. It was like up 15%, which is one of the largest, or if not the largest move ever, single day in crude oil markets. So a couple things this does. One of the things that it's going to do is put kind of at least short-term inflationary pressures as a whole on the market. So that will be a little telling in terms of the Fed rate cut decision and other kind of inflationary indicators, just as prices go up. As I turn on interest rates, there is a strong correlation between interest rates and oil, so this would be generally supportive, and we'll look at that again in a second, of higher interest rates. And yeah, so I mean that is one big takeaway, and it certainly helps oil rich countries as well in terms of any sort of dollar shortage issue that they have. Every dollar higher that they can get, that's that much more debt that can be sustained for a longer time. So the sort of risks for that big debt overhang decrease because of that. So in one sense, I like the move here in oil, supporting my overall thesis that if we're going to continue to see kind of a run up here in the U.S. markets, and at least a continued hold on any sort of recessionary issues. So that's kind of my take on oil here. You can read the other articles that are out there. Everyone's got a hot take on what the geopolitical implications of this are going to be. I don't know, and I think anyone is, they're all guessing at that matter. What we do know is what the market's priced in right now, and even though we had a huge day yesterday, in the grand scheme of things, we're still very much range bound here. And in my mind, I don't think if we do push higher than the highs that were put in April, that we get much higher. And I think it would be generally short lived before you reprice back down to say 50, 55, kind of more in line with where my assessment of the price of oil would be at. Again, once things kind of correct themselves. So I do think, though, at least at this point, we've maintained the initial burst up, meaning this isn't going to be a major false breakout, and it does make sense that we get a little momentum following through with oil. So there's my take, and I guess I'm more interested in the implications on kind of everything else in the global macro environment that I am on oil necessarily. Even after this pop, I don't really think this is a great opportunity to jump in here by any stretch of the imagination. And again, in the grand scheme of things, despite yesterday being the biggest single day percentage move ever, at least upwards, we're still pretty range bound in the grand scheme of things. All right, I had a question on the upcoming rate decision, kind of what positioning should be, or what some thoughts would be there. So let's go ahead and go over that. The question was, what do you think about the rate cut chance next week? Although the market pretty much has priced in a cut, my feeling's telling me that it won't, and if no, the initial market reaction may drop, followed by a slingshot high due to fundamentals. And so the question would be, am I better positioned myself and towards a no cut, and then possibly get back in at a better entry point? Let's talk about the rate cut, and then we'll talk about positioning and kind of how I play it. And you can take my thoughts and do what you will in terms of how you decide to actually execute. As you mentioned, it seems like if we just look at the headlines, and I was just Googling Fed cut and that sort of thing, it seems like the headlines are probably right where the actual odds are, which are two cuts for every one no cut. And that would make sense because the vast majority of these articles are going to pull from the Fed Watch tool, which is really just a simple algorithm that determines odds of a cut based on where option and future values are on interest rates and bonds. And so as you can see, we're getting. Let me go back to the current. So the target, or the current target rate, is in this kind of checkered pattern right here, and the percentage odds, meaning a cut here to the left, is right here. So right now, the odds of a cut are 2/3 to 2 to 1. But if you look at the historical data, you can see there's been a big shift over the last couple of weeks. Just a few weeks ago, it was all about 100% chance for a rate cut. Obviously, again, now these are converging very fast, and possibly even by Wednesday, it might be a 50-50 shot here. So I'm completely tracking with you. I think there is a much higher potential than the market sees of a no cut here. And even if there is a cut, I think the expectation for no future cuts will certainly be set out. And I track, in terms of kind of determining what the odds are going to be of a cut, I think it's much better to track 3 data points: employment, inflation and growth, as those have been the really the markers that the Fed themselves have always said they pay attention to over and against anything else. So if we do look at those, looking at employment, so I've inverted the 10-year yield here. If we look at employment, all things considered, the employment picture looks pretty darn good, and you can see the very big kind of gap between. Oh, look at that. Must have talked about this recently. Let me clear this off here. Erase all. You can see the very big gap that has emerged between the where the employment rate is at and where interest rates are. I mean, in other words, I think the Fed has likely kind of overshot what the data is actually telling them at this point in terms of interest rates. In other words, we're just not really seeing it yet in terms of the employment data right now. Let's see. The other thing they're going to look at is inflation. So looking at crude oil is kind of an inflation corollary, even though it's not one-to-one. Again, we did see a bit of a drop in the overall price of crude oil, but I still think that overall, inflationary speaking, we've kind of, again, the Fed's overshot. We haven't seen the sort of disinflation or deflation that would normally predicate the sort of rate cut environment that we're in right now. And then finally, from a growth perspective, using GDP as a marker here, I mean, granted, GDP's waned a little bit, but definitely within expectations. And again, seeing a big gap between kind of reality and what the Fed has priced in. So I've kind of made this argument before. I think the Fed is looking way too much at the market as opposed to realizing that they are the price setter, that the market's not the price setter. And I think Chairman Powell really is a little bit lost on what to do. All that being said, I mean, if based on kind of historical, what the Fed has said they've done in the past and the rationale for the decisions they made in the past, based on that, there should not be a rate cut. But with that being said, obviously President Trump has been jawboning Chairman Powell to cut rates, and maybe he might cave. So there is a lot of risk there, and I think there's a lot of uncertainty on exactly what's going to happen. We'll obviously find out on Wednesday. So what does that do though in terms of positioning? I do think you're right that we could get a bit of a sell-off after the initial statement, and then a follow through with a rally. The only question is, how long will that last? And this is the overall difficulty. So this is how I think about it, at least in terms of a situation like this. And this is why I don't try and personally trade these situations real time. That's not to say that people can't have a skill set where this is where they can. I just know myself and know my strengths and weaknesses, and would rather just kind of wait out any sort of selling and let it roll, as opposed to try and play this in real time. Because here's generally how I think about it. We have one of two options after the rate cut, right? We were either going to go up or down. And if we go down, the question then becomes how much. So you have that risk. So let's say best case scenario, we get out, we go down. The first question is, how far do we go down? And then where do we re-enter, right? So we have kind of that variability in terms of what are we actually going to gain from any sort of sell-off. Is it going to be just a 0.5% that day? Will it be a percent pullback, 2% pullback to finish the week off before we get rolling? How far back do we go, and when do we re-enter? That can be tricky. Obviously, we have technical tools to deal with that, but it's just it's a tough thing. So let's just say we even gain that 1% in terms of a better entry point, in terms of a pullback after that. Well, then you have to then kind of divide that by the risk of what if we don't go down, and what if we just do go up, right? Let's say we do just rocket, and for whatever reason the the response to the rate cut is a positive response, and just knowing the kind of the fundamental situation we're in and the overall chart pattern that we have here, that we could see a rally coming out of the rate decision on Wednesday, then you are risking being out of the market with the market beginning to rally. And for me, just right after that initial decision, you either get kind of usually a big pop or a big drop, which tends to be a false move, and then you get the kind of the real move after that. But sometimes it's a double false move, and then you get kind of how the next week is actually going to play out. So you get a pop, you get a drop, and then you get a rally, or you get a drop, a pop, and then finally a pullback, those sort of things. I mean, we've all seen it. So just getting the positioning in can be a little bit difficult unless you are very nimble of a trader, and that's just it's not a skill that is my strongest. So that's why, at least for me, I'm likely just going to hold and let happen what happens in terms of the Fed rate announcement, in terms of how it is on the equity side of things. Just knowing that at least weeks from now, months from now, I wholeheartedly expect equities to push higher. But again, if you feel a little bit more comfortable trading those situations a little bit faster, and you think you can gain an edge there, I know that is a real possibility. Go for it, and just take my thoughts and as they are as just kind of consideration for why I don't do it. Speaking about positioning, another thing I did want to talk about real quick is the bond position that we're getting pretty darn close to back to my initial entry position. I'm going to go ahead and pull up TLT here, and I entered back in July as we were consolidating right here, and so obviously we've seen TLT drop pretty nicely. My expectation or my goal or my thought here is that we're going to get some sort of pattern like this with some RSI divergence as we find prior resistance, which should now be support, and that's probably where I will get rid of, finally exit this position, just to let you guys know kind of what I'm thinking about as we finish off the as TLT kind of approaches this prior spot, and I do think we'll likely get there, both from a technical and just a macro perspective. So just to give you the heads up that if we do reach where I entered, I'll probably go ahead and close the position. Even though I think we could go a little bit lower, I'll probably close the position for a break even. Little unfortunate in terms of how this played out, but all things considered, I do think a lot of this was a very false move, and we're certainly seeing this as TLT bonds kind of come back to where this move began. So just thought I'd update you on that position as well, and then that would finally kind of give me a little bit more cash to play with and see where the next opportunity might lie. Anyway, that's going to be it for this update, and good trading everyone for the rest of the week, and we'll see you next time. Bye bye.